What's going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. If you don't remember from last time, my name is Alex Savanovich, and I'm going to be your host for this show. So, similar to past episodes, we are going to answer some questions that we received from viewers over this week. I made sure that I chose some interesting ones so we could have a good discussion today about topics that are relevant to the market right now, things that are relevant to trading, and things that might just help out. So, without further ado, let's dive right in and address question number one. So, question number one says, what were your biggest takeaways from Jensen's keynote at GTC this week? All right, so Jensen gave a keynote speech at the GTC conference on Monday. I'm going to keep this pretty short because I didn't actually watch the entire conference on CNBC or watched it live. I just sort of read some of the commentary after the fact. Number one, as you all know, and you probably heard and read elsewhere, this $1 trillion in sales that he projects for NVIDIA out till 2027 is insanity to me. To try and forecast that far out and continue to be a salesman and continue to push his product, I don't think it's a great look. I don't think it does any analysts any favors. I don't think it does his company any favors setting a bar that high. If they don't meet those expectations, I can only imagine what that means for the stock. I could go on and on and on about why I think that makes zero sense. You see what I did there? But yeah, I sort of just thought that was ridiculous. And you saw how the stock acted last quarter with a good print, sold off. And we spoke about that on an episode a few weeks ago. And we spoke about that on the episode where we had Ethan on. And I just think the market in general didn't digest that number really well. You saw that when he announced that, the stock ripped briefly and then sold right off and was sort of trading where it was before he even dropped that one liner. So, if you're someone reading the tape like I am and you're watching the action all day long and you see that happen, your takeaway is nobody seemed to really care that he threw that number out there, and his credibility is not really intact if you were to ask me. Now, the second thing I want to point out was there was a lot of hype in the last few months, not even just the last few months, but the last year and change regarding co-packaged optics, optical fiber being used to transfer data across chips, et cetera, et cetera. I don't understand the science to a T. I get it sort of when I read analyst reports, and I understand that Lumentum, Coherent, AAOI, I'm not even going to try to pronounce the company's name. I think Applied Optoelectronics or something like that. But these stocks obviously saw massive runs the last few months and even the last year and change, like I said, based on the assumption that most of these chips that NVIDIA is bringing to market, some of these newer age chips that are specialized for AI, would utilize these connections. Now, at GTC, Jensen mentioned that copper cables were still going to be heavily relied on. And initially, you saw all of these co-packaged optics exposed names sell off, and they sold off pretty hard on the day. And if you watch the price action the days following, those names all found their bid again. So anyway, that was just a little bit interesting to me to see that price action following his comments regarding copper, regarding co-packaged optics, witnessing those stocks shake that off from somebody who's supposedly a prominent figure in AI, in chip technology, i.e. Jensen, was interesting price action, and I don't think should go unnoticed. Now, those are my two takeaways that I thought were sort of interesting. I'm not going to comment on much else that I saw there. NVIDIA obviously didn't have a crazy stock reaction to that news or to anything that Jensen said at GTC. So I think it begs the question, how much credibility does the NVIDIA CEO Jensen Huang have left? If he continues to be a salesperson like he has been, does his credibility continue to dwindle? In my opinion, I think it already has significantly. All right, so let's move on to question number two. What do you make of this geopolitical headline-driven market? I'm getting stopped out so often. Do you have any advice? Question mark, exclamation mark, exclamation mark. Someone was excited to ask this question. So obviously nobody is a stranger to the endless amount of headlines every single day. It feels like there's something coming out of Iran about blocking the strait. There's something coming out of the US where Trump says that we've almost won the war, but the war is still continuing. Israel continues to bomb assets in Iran. Iran continues to return the favor and bomb assets around the Middle East. Oil today closed out on highs. Today, at the time of this recording, it's Wednesday evening. I want to say that USO, which is the US oil index, ETF index, I can't remember, closed out at like 121 or something out on highs. So there's endless headlines and the market seems to whipsaw. There's also private credit concerns that we've spoken about. There's hyperscaler concerns we've spoken about. There's so many things happening in the market simultaneously that it's tough to get a directional bet right now. And I get that. It is tough. And if you're not a pro or you don't do this often, you don't pay attention often to just put a stock on and wait a few days, it seems risky and you might get stopped out very easily. My advice to you would be shorten your time horizon in times of uncertainty. Trying to put on a multi month bet on something occurring right now, you might get whipsawed 20 times between now and when you thought the idea was going to play out. So, shorten your time horizon or take money off the table and sit on the sidelines. I think one of the best pieces of advice I've ever received as a trader from my mentor was sometimes the best thing you can do is sit on the sidelines, watch, take notes, and observe. Because if you're going to be in this game for a long time, if you want to do this for the rest of your life from, let's say you started when you're 20 or 30 and you want to do this until you're 60, 70, 80, Warren Buffett obviously did it up until his 90s. You want to have longevity in this game. Sometimes the market is just not conducive to your style or there are no really great ideas. And the best thing you can do is sit on the sidelines and take note. And if you are in this game for as long as Warren Buffett was, I'm not saying everyone who's listening to this is an avid trader or even wants to be an avid trader slash investor. But if you are someone who is in that camp, you can bet your top dollar that at some point between now and the end of your career, you're going to see this same sort of scenario where there's tons of headlines or geopolitical risk or asset bubble forming. You will see this sort of thing play out time and time again. These are just part of normal business cycles, and geopolitical risk could happen at any moment. So take note and learn from it and watch, what sectors are moving when certain headlines hit the tape and make mental notes or write down notes and you will learn for next time and you will be able to trade this sort of choppy market better next time. Maybe not now, maybe not even the next time, but at some point in your career, you're going to say, wow, I've seen this now 3 or 4 times and I know what I'm supposed to do. And sometimes what you're supposed to do is just sit on the sidelines, like I said, and there's absolutely nothing wrong with that. So let's go on to question number 3. Every analyst was penciling in a rate cut. Now people have switched their opinions. Some see no changes to rates. Some say there may even be a hike. What is your opinion specifically on this? What do you think will occur? This is a phenomenal question, and it's I think, a multi-dimensional question. You can't just point to one data or one piece of data, sorry, and say because of that, I think there's going to be a rate hike or a rate cut. I think obviously when you're talking about anything regarding economics and rates, you need to take into consideration the entire picture. So I'm going to start by saying oil has now been sustained above $100 a barrel for roughly 2 weeks now. I think by the end of this week, it will have been 2 weeks and change. That is hurting the consumer. Today, we got the PPI, which showed that there was some pretty good inflation in those figures. So I think that's going to start to trickle down and harm the consumer. Now, when that does harm the consumer, you're going to see a pullback in discretionary spending. There's already cracks beginning to show in the credit market. I think personal consumer loans, the defaults and charge-offs are starting to accelerate. So that's a little bit concerning. I think the buy now, pay later defaults are starting to accelerate. You saw this year, a lot of these fintech and buy now, pay later exposed names have sold off pretty aggressively. That is sort of giving you the warning, flashing yellow light that something might be wrong there. Obviously, the banks have sold off pretty aggressively so far in 2026. So when you take all this into consideration, obviously, oil being very high, oil is a big input cost to a lot of goods that are made in America. If that starts to reflect or show up in CPI print and like the PPI that we saw today, that's going to harm consumers. They're not going to spend as much money. That might cause a little bit of GDP contraction. Who knows? But at the same time, if inflation runs hot and the consumer is hurt and they're not spending as much, the Fed might say, hey, like we have to stimulate this economy because GDP is slowing because consumers are not spending. They might want to lower rates, but it's difficult as the Fed to lower rates when you have inflation still running higher than what their target is, which is 2% a year. But if you hike rates, that obviously harms the job market, that harms businesses. The cost of borrowing money, just the cost of money in general, increases. So the Fed is in a very precarious situation. There's a lot of things to consider. My personal opinion is that if oil continues to be as expensive as it is, and you start to see it show up in inflation, and the consumer really starts to feel the pain, I think the Trump administration, just from what I've seen and what I've read, is going to decide to favor Main Street, which is just America in general. And I think whoever becomes the next Fed chair, Trump is going to be in their ear about lowering rates. And I also say that because Trump is a large supporter of a rate cut, and he does have his hand in who is going to be, he does have a say in who's going to be the next Fed chair. So there is a little bit of Fed independence going out the window there. I would say if the Fed was acting purely independently after whoever the new chair is, maybe there's a chance there's a rate hike or they keep things normal. But I think because Trump is going to have the ear of whoever becomes the Fed chair, it looks like Kevin Warsh right now. I would personally, just given everything that I've seen, and some people might disagree, agree. Personally, I think there's probably a 65% chance, in my opinion, of there being a rate cut before the end of the year. And the remaining probability, I would say, no, I would say probably 25% chance there's a rate hike. And whatever's left over, I would say stays the same for the year. That's the probabilities that I would apply to all the outcomes when answering this question. So let's move on to question number 4. What is your process after a bad trading day? What do you do to decompress slash recover and get ready for the next opportunity? So I think before answering this question, you have to define what a bad trading day is, because if in my world, if you've put on 5 trades in one day, for example, and all 5 are losers, and sometimes it's going to happen, that's not necessarily a bad trading day. Do I feel bad? A little bit initially. I'm like, oh, dang, that sucks. Like, I wish I could pull one winner out of the 5. That's really awful. That's obviously a tail outcome. That's not going to happen every single day, but it does suck, and I get it. But that, in my opinion, is not a bad trading day. If you stuck to your stops, you stuck to your system, you didn't break any rules, and you just traded the way that you know how and played the game the way you know how, that's not a bad day. You didn't do anything wrong. This is a game of probabilities, and some days you're going to go 0-5 or 0-4 or however many trades you put on per day. Some days you're not going to have a single winner. It's a rare occurrence, but it'll happen. And you just got to take the punches as they come. And if you stuck to your rules and system, you come in the next day, you stick to your rules and systems again, and you will have a tail outcome on the other side at some point next week where you have 5 winners and you make a lot of money, and then you'll feel great. I don't, I'm not condoning you feeling bad when you lose and feeling good when you win. I think you should stay pretty neutral, because in this business, you're going to do a lot of winning and the wins will be huge some days, and you're going to do a lot of losing and the losings will be huge some days. You should be capping your losers at your risk amount, but sometimes things happen. A stock will blow through your stop, and that's part of the business, and you have to factor that in. That's your slippage. So to answer the question, if that's your idea of a bad day, then really there's nothing to do to decompress. The probabilities were not in your favor today, and that's it. And you come in the next day just as you did the day prior, and you execute your system the best way that you know how. Now, on the other side, if you truly did have a bad day and you violated stops, or you did things that were reckless, or you gambled a little bit and you put on trades that don't have positive expected value, that's a completely different thing. And I can't say that I do that anymore. I feel like I have a system, I trust it, I execute the system, and I do the best that I can according to my system every single day. But if you do things like what I just mentioned, and you break your rules, or you didn't follow the system that you've built for yourself with positive expected value, I think you have to take the day and really reflect, journal a lot, go on a walk, go outside, shake it off, because something when that sort of thing occurs, it can really harm your confidence and make you feel like you don't understand the market, and you might be inclined the following day to put on even riskier trades to try to make back the money. And that's a really, really tough place to be in. And I would say in that situation, you might even want to take a day off, take a breather, just watch the market for the day. You know, Watch the stocks that you would have put on if you had stuck to your system. And when you're journaling, don't just journal your entry prices and where you exited and what you did physically. Obviously, you need to do that to remember when you read back on your journal, but write about the emotions that you felt and why you decided to gamble on a name, why you decided to buy a stock when it had already ripped 8%. Why did you decide to sell a stock when it didn't really do anything yet and it wasn't even at your risk amount, but you were trying to sell it early? These are, mental errors, and you need to get to the bottom of it and figure out why did that mental error occur? What were you feeling that triggered that response that was not part of your system? So that's what I would say is an answer for that question. If you stuck to your system, great. There's nothing really to do. You just come in the next day and you stick to your system again. The probabilities will be in your favor at some point and you'll make back the money. But if you were reckless, that's a completely different story. So let's go on to the final question. What is going to happen if you are wrong and Trump does not find an off ramp in the Middle East and instead doubles down on the war effort? Well, I'll tell you something. That will mean that my little short on oil that I have is going to hurt, and I'm going to have to cover it pretty soon. Um, if I'm wrong and there's no off ramp and this war continues for an extended period, I think that's a huge headwind to the market because that means, like I said earlier when we were talking about rates, the American consumer is going to really start to feel that pain. And if you start to see consumption go down or GDP start to contract, I don't think this market that's currently at all-time highs or trading in this range near all-time highs is going to take that very well. I know I said last week it's trading at 25 times earnings, which was an incorrect figure. It's roughly 21, 22 right now. This market's not going to take that well. And I don't think it's crazy to say that another country might get involved. I don't know if it would be China. Russia's got their own thing going on, but I feel like someone is going to step in and support Iran in some way if this war drags out. And that would be a scary outcome for the market. I don't really have a whole lot to say on that question. There's a lot of speculation. If you go on any social media, people are saying some crazy things and predicting some crazy things that I'm just going to tell you what I think the tape is going to do. I think Trump would probably lose his midterm election, and I think it would be very difficult for the Republicans to even win in the next general election. Because remember, this is something that Trump ran on, that we weren't going to get into another forever war. So if it turns into another forever war, I'm not saying that it will, but if it does or it starts to look like it will, it's going to have some really negative implications for the market. So that's what our 5 questions for today. I feel like we went through them in decent detail. I noticed I started to ramble on a little bit there when I was answering a few of those. Forgive me. You can always skip or play this back at 2x speed if you're like, geez, this guy's just talking too much. But thank you so much for listening. Make sure to check us out. We post shorts on TikTok, on Instagram, and I put them on YouTube as well. If you go to the YouTube Shorts section where this podcast is posted, make sure to check out this podcast on Spotify and on YouTube. All the links are in the bio. You know what to do. Go follow, go like, leave a comment. And I really appreciate everybody who listens to this and engages. It only makes this podcast so much better. So thank you so much for listening. Always remember that makes absolutely 0 sense. Take care. Have a great Friday and a great weekend. I'll see you next week. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.